Hey everyone, welcome back to Corporate Decoder, the place where we decode the wild world of corporate finance. And let me tell you, Proem Acquisition Corp is filing as a wild ride, like a SPAC trying to find its place in the universe. So, Proem Acquisition Corp, this is a blank check company, a SPAC if you will. And they're looking to merge with another company, probably in the tech space, but they haven't found their perfect match yet. They've just filed an amendment to their registration statement, and we're going to dive into what that means for investors. Imagine going on a blind date hoping to find your soulmate, but you don't even know what you're looking for. Yeah, it's kind of like that. This filing is essentially an update to their initial registration document, telling the Securities and Exchange Commission, or the SEC, that they're still in the game and refining their plans. This is amendment number 1, so they've already made some changes since the first filing, and this one, dated the 15th of January 2026, gives us the latest snapshot of their intentions and financial outlook. The company itself, Proem Acquisition Corp I, is a brand new entity, formed just in July of 2025, based in the Cayman Islands. But with its principal executive offices here in Dallas, Texas, you probably guessed it by the phone number. Being a Cayman Islands company means they're structured for international business and have some tax advantages, but it also means navigating different legal waters than a typical US company. Right now, they're checking the box for non-accelerated filer, a smaller reporting company, and an emerging growth company. This basically means they are new and have fewer reporting requirements for now, which is pretty standard for a company at this stage. When do they plan to actually sell these securities, you ask? Well, it's designed to be as soon as practically possible after the registration statement is officially approved by the SEC, meaning they're ready to hit the market once the green light is given. They're planning to offer 13 million units, each unit costing $10. Now, each unit is not just one share, it's one ordinary share plus one third of a warrant to buy another share. Think of it like getting a bonus ticket for a future lottery, except it's for stocks. These warrants can be used to buy shares for $11.5 each, but only after a certain time, and they expire after 5 years. The tricky part here is these warrants are a bit diluted since you get a third of a warrant per unit instead of a whole one, which they say makes them a more attractive partner for target businesses. The total offering is aiming to raise a cool $130 million. They'll put most of this money, $130 million to be exact, into a special trust account. It is like a secure vault for the money they'll use to find and buy that perfect business combination. Now, let's get to the core of it. Proem Acquisition Corp I is a blank check company. That means they exist solely to raise money from investors like you and me, with the sole purpose of merging or acquiring another business. They haven't picked a target yet, so it is a bit of a financial adventure. This is their first dance with the public markets, an initial public offering, or IPO. What's important here is the structure. One ordinary share and 1/3 of a warrant. So what happens if they can't find a business to merge with? Well, their plan is to give the investors their money back. If they can't find a deal within 24 months, they'll have to liquidate and return the cash in that trust account, which is expected to be around $10 per S-share. This is a crucial safety net for investors in SPACs. Now let's talk about the insiders. Their sponsor, Proem SPAC Partners LLC, is buying an extra 292,500 units in a private deal for about $2.9 million. This shows they're invested, but it also means they got in at a much lower price, approximately $0.005 per S-share for their founder shares, which sounds incredibly cheap, and that means they could make a substantial profit even if the deal doesn't go perfectly for public shareholders. This is a classic SPAC dynamic. The founders get a sweet deal, which can create some interesting incentives. This is a big deal for you as an investor because the sponsor got their founder shares for practically pocket change. Your investment will be significantly diluted right from the start. It is like buying a slice of pizza, but a good chunk of the whole pizza was already promised to someone else for almost free. And here is where it gets really interesting, especially when we look at the dilution table. This table shows us how much your investment could be worth based on different scenarios of shareholders redeeming their shares. If nobody redeems their shares and the underwriters fully exercise their option, a best case scenario for the company, your net tangible book value per S-share or NTBPs, is projected at $7.15. That's already a big drop from the $10 you paid per unit, showing that initial dilution we talked about. But look at the maximum redemption column. If a lot of shareholders decide to get their money back, your adjusted NTBPs could drop to $6.14 per S-share. That's a significant loss from your initial $10 investment, purely from the dilution and redemption mechanics, before even considering the potential performance of the target company. And here is the kicker regarding the sponsor's stake. While your investment per ordinary share is $10, the sponsor's investment per S-share is a minuscule $0.005. Even with maximum redemptions, their investment could still be worth significantly more than what they paid, a potential huge win for them. Even if the stock price struggles, this is the incentive structure we need to be aware of. The company's strategy is to focus on global technology businesses with strong growth potential, leveraging their management's experience in areas like AI, blockchain, and cybersecurity. They believe their team's expertise and network will help them find and integrate a successful acquisition target. Let's look at the leadership. Imran Khan, the CEO, has a pretty impressive background, having been Chief Strategy Officer at Snap Inc. and a top banker at Credit Suisse and JP Morgan Chase. He knows the tech and finance world inside out. Greg Pearson, the CFO, also brings a wealth of financial experience, having worked with hedge funds and asset management firms. And the independent directors, they read like a who is who in the tech and finance world. John Wu, president of Ava Labs, behind Avalanche Blockchain; David Eckstein, CFO of Vanta; Amana Thombre, former CEO of Match Group Americas; and Andrei Kazakov, CEO of Adjust Inc. This team has serious credentials in scaling and managing tech companies. The sponsor itself, Proem SPAC Partners LLC, is structured to invest in this company with Imran Khan as the managing member. They're getting paid $10,000 a month for administrative support, and importantly, they're buying those founder shares and private placement units at a very low cost. Those 4.3 million founder shares they bought for just $25,000 are a major point of dilution for public investors. They're essentially getting 25% of the company for practically nothing, which is a common structure in SPACs and creates significant potential profit for the sponsor. Now, let's talk about the risks. And there are many. They highlight the risk that shareholders might not get to vote on the deal, or that even if they do vote, insider shares will carry so much weight that the deal might get approved, even if most public shareholders are against it. This is a critical point for investors. Your main power to influence or exit your investment related to the business combination is by redeeming your shares. You don't get much say beyond that unless there is a vote, and even then the insider votes make it easier for the sponsor's preferred outcome. They are very upfront about the dilution caused by the sponsor's cheap founder shares. It means that even if the deal is successful, the sponsor is almost guaranteed to make a substantial profit on their initial investment, even if the stock price after the merger declines. This is a big red flag for potential investors looking for a fair entry point. When you see numbers like $0.005 per S-share for the sponsor versus $10 for you, it is a stark contrast. Another major risk is that the money in the trust account, which is supposed to be for investors if no deal happens, isn't entirely protected from third-party claims. So if the company faces lawsuits, your $10 per S-share redemption might become less than $10. Looking at their balance sheet as of the 30th of September 2025, they have very minimal assets and a working capital deficit. This is typical for a SPAC before an IPO. They literally have more liabilities than assets when you account for everything. The $92,000 in deferred offering costs shows money spent getting ready for this offering. Their statement of operations shows a net loss of over $50,000 for the period ending the 30th of September 2025. This is expected for a pre-revenue company, but it emphasizes that their entire existence depends on finding and closing a deal. They have a promissory note to their sponsor for $85,970. This is money borrowed from the sponsor to cover immediate expenses, highlighting their reliance on the sponsor for early funding. It's basically a loan to keep the lights on before the public offering. This really sums up the core risk. You're entering an investment where the insiders have a massive advantage in terms of their entry price, setting up a situation where they are highly likely to profit regardless of how well the public shareholders fare. As expected, the tables show that the sponsor, Proem SPAC Partners LLC, will own a significant chunk of the company, about 26.1% after the offering. This gives them considerable voting power. The auditors with Smith Brown PC have flagged a going concern issue. They explicitly state that the company's ability to continue as a going concern is in doubt due to its lack of capital resources for a reasonable period of time. This is a standard disclaimer for SPACs. But it's important to remember they need that successful business combination to survive. They've got a lot of ordinary shares authorized, 200 million of them, meaning they can issue a lot more shares in the future for acquisitions or other plans. This is important to note because it highlights the potential for future dilution if they need to raise more capital. So, what is the takeaway here? Proem Accession Corp eyes a newly formed SPAC with an experienced team and a clear strategy to target tech companies. However, the structure of the deal, particularly the sponsor's founder shares bought at a rock bottom price, creates significant initial dilution for public investors. The key risks revolve around their ability to find a suitable business combination within the 24-month timeframe and the potential for their sponsor to profit substantially even in less than. Ideal merger outcomes. Investors are paying a premium for a blind date, hoping the chosen match lives up to expectations. While the matchmaker, the sponsor, is practically guaranteed a payday, what do you think about these SPAC dynamics? Is the sponsor's low entry cost a red flag or just standard practice? Let us know in the comments below. If you found this breakdown useful, please hit that like button. Subscribe to Corporate Decoder for more deep dives into company filings and join our Discord community linked in the description. Thanks for watching, and we'll see you on the next one.